All right, we want to be respectful of everybody's time, so we'll go ahead and get started. My name is Jenna Rittenhouse. I'm the marketing director here at Jessup Wealth Management. Thank you for hopping on our August market update on Zoom. We've started this just as volatility has kind of been prominent in the markets, just so everybody can hop on together, answer questions, and or ask questions and get your answers right away. So Mark is about to do a market recap. I just have two disclaimers. One, this recording is started, so we can redistribute this market update on our YouTube page. So it is being recorded, just wanted to let everybody know. And second of all, as you might have noticed, you are currently on mute, and then I will come back on and instruct you how to unmute yourself so that you can ask any questions once we open it for the Q&A. So I'm going to go ahead and turn this over to Mark McEvely, our Chief Investment Officer here at Jessup Wealth Management, for the August market update.
Thanks, Jenna. Hi, everybody. Welcome back to our third monthly market update webinar. Again, as Jenna said, the purpose of this webinar is for us to convey our market outlook in real time and give you the venue to ask us questions that you have on your mind. So tonight I'm joined by our CEO, Matt Jessup, and I'm going to leave some time at the end of my presentation for Matt to give his 2 cents on the market if I were to miss anything, okay? So a quick disclaimer before we get started: this is not financial advice, nor is it a recommendation to buy or sell any investment products. And this is meant for educational purposes only. So I'm going to go ahead and share my screen with everybody. Jenna, can you see that okay? Good, okay. So to kick it off, I want to get started with a thought experiment that I read about in a blog post by Taylor Schulte, who is a CFP and founder of Define Financial. I wish I could take credit for this brilliant exercise, but I can't. So this was really insightful when I read it by Taylor. So he starts out like this. Imagine that on January 1st of 1992, you meet a prophet who tells you the major events that will occur over the next 30 years. Here are the few noteworthy proclamations the prophet makes. 2 of the 3 worst stock market declines in US history, a 10-year period where the stock market return is negative, a downgrade of the United States debt, a nationwide housing and mortgage crisis, the worst attack on US soil since Pearl Harbor, a 13-year war in Afghanistan, an oil price spike to almost $150 per barrel, an intense political divide, the first global pandemic in 100 years, and lastly, the highest inflation rate in 40 years. With this being the case, how would you have invested your money? I'm not guessing it'd be so optimistically, and I'd be the same way. Admittedly, even for me as a proud equity investing advocate, I would have been difficult to invest in the stock market knowing what was coming. But as you have probably guessed, this would have been a foolish approach because here's exactly what happened. The day after you received this information from the prophet in January 1992, the S&P 500 opened at $417. As I write this, the US stock market index stands at 3,983, almost a 10-fold increase. And that does not include dividends, which have grown from $12.39 to $59.20. In other words, your dividend income has increased 5 times during a period in which inflation is up about 2 times. And for context, this would have turned $100,000 into more than 1.6 million. With all that happened, the market still offered a total return of 16 times. Compound interest is mind-boggling, which is why Charlie Munger famously said, the rule of compounding is to never interrupt it unnecessarily. The next 30 years are sure to include many events that feel like the end of the world as we know it. But with history as our guide, sticking by our plan has proven to be the prudent approach time and time again. So that's the end of Taylor's thought experiment. And I bring this up because this is not going to be the last time we go through scary, stressful times in the market. There's always going to be something out there that has a risk to quote unquote wreck the equity markets. But at the end of the day, we have to stick to our game plan. We know the market goes up more than it goes down, and we need to stay positioned appropriately to take advantage of that. Okay. Moving on to the second slide that we have. So last week, we received the latest GDP report, which was for Q2 of 2022. Q2 was the second consecutive quarter of negative GDP growth for the US, which formally put our economy into a quote unquote technical recession. The equity markets reacted pretty positively to this news, actually, as investors believe that it will actually force the Federal Reserve to ease the pace of interest rate hikes in the future, which is going to be beneficial for the stock market. The image shown on this screen is investment performance for the next 3 months, 6 months, and 1 year after the US has historically reported 2 consecutive quarters of negative GDP growth. So as you can see, the further and further you go out after 2 negative quarters, returns tend to be pretty good. So people again might be questioning, well, Mark, we're in a recession, so why is that a good thing? And again, everything that I say during this Zoom webinar is relating to the equity markets. So we know that the market discounts everything in the future. And we think that over the previous 6-7 months, the market has been pricing a recession in. Hence, we think returns over the next couple of years are going to be pretty strong for the markets based on the data that we have. But another question that I want to pose is, are we really in a recession right now? One of my favorite writers in the financial industry wrote a blog post earlier this week. His name's Jack Rains, and he said it best earlier this week. Said, quote, considering that over the last 6 months, tech stocks have crashed 80%, crypto is dead, bonuses are down, inflation is high, gas prices are higher, and layoffs have been hitting in waves. It certainly feels like a recession. And yet I sit here in a packed coffee shop in Atlanta, Georgia, and business is booming. There are 30 people in line for lunch, and the baristas have been busy all morning. The Braves game I went to last Tuesday, a Tuesday, was sold out. No one at the party I attended Saturday night seemed overly concerned with the economy, and the Atlanta airport was packed on Monday morning. In the real world, American Express customers are spending 150% more on air travel, 90% more on lodging, and 48% more on restaurants than they were in Q2 of last year. And that's just experience spending. Total spending is up 31% year over year. So my question that I'm posing is, which is it? Are we in a recession or are we not in a recession? But the thing that I want to get across is, with regards to the stock market, does it really matter? Does the existence of a recession imply that we should cut back on our investments or change the composition of our portfolio completely? In my opinion, that's a no. With all that has happened over the past 30 years that I highlighted in the beginning of this presentation, here we are with the S&P 500 roughly only 15% below its all-time highs. Moving on to areas of concern for investors. China right now is the newest source of geopolitical tension that gets added to the long list that we've experienced this past year. And Chinese citizens are really, quite honestly, on the verge of a revolt over the country's banking and financial systems. Their citizens are refusing to pay mortgages, and developers have not finished properties that owners have already paid for. To add on top of that, House Speaker Nancy Pelosi just landed in Taiwan today, despite threats from the Chinese government warning her not to come. And again, in my opinion, this has kind of reignited the debate over American participation in Taiwan and the extent to which China may eventually invade Taiwan. And I just want to be crystal clear. I'm not trying to scare anybody, but it would be a major issue for the global economy if China did launch an invasion of Taiwan. So this is something that we're going to be monitoring going forward. Obviously, the ongoing fight in Ukraine, where Russian forces, quite honestly, from the data that I'm looking at, are running low on supplies, and both sides are suffering too many casualties. This is adding more tension in the background. And obviously, high food and energy prices are a major source of conflict worldwide right now, which is kind of allowing Russia to control the European gas markets, which is never a good thing. Other things that have happened in the past month, the government of Italy has fallen. The Prime Minister of United Kingdom resigned. Previous Prime Minister of Japan, Shinzo Abe, was slain. And Brazil is getting ready for a presidential election this autumn. And are these really threats to the markets? No one really knows for sure, but these are stories that we're watching closely, and we're going to continue to watch and monitor. Obviously, if we needed to make portfolio adjustments based on any of those geopolitical events going on, we'll go ahead and do that. But we tend not to make portfolio adjustments based on things potentially happening, okay? Next, I want to go over a chart of the business cycle. So late in the business cycle, bonds tend to peak and break down first. So as you'll see on the screen right now, bonds are the green line, stocks are the blue line, commodities are the gold line. So bonds are going to peak and break down first, followed by stocks within, it depends on every cycle is different, but usually what you're going to see is bonds are going to roll over, stocks are going to roll over, and then commodities are going to roll over, and the cycle resets itself. Okay. So it appears, at least for right now, looking at this chart, to me, bonds and stocks have found a short-term bottom. Commodities have not found a bottom yet. They're still kind of in free fall, like I mentioned at the last previous Zoom market update. That is what we wanted to see to kind of complete this market cycle. Is after commodity prices surged after COVID, we wanted to see those come down. We wanted to see the bond market and the stock market recover. And that would give us more evidence to get more aggressive and add risk back on the table inside of client accounts, because everything goes in cycles, everything goes in waves. But with inflation coming down, interest rates on US government debt coming down right now, all that stuff is really positive for the stock and bond market right now. So again, in the last couple of podcasts that myself, Matt, and our Director of Research and Trading, Nick Whitaker, have done, this to us feels like it's brewing to be a perfect storm to have a really strong finish to the year the closer we get to the midterm elections. And again, looking at history, seasonality favors having a really strong Q4 this year. Last thing I want to go over before I turn over to Matt is I just wanted to share this graphic on the screen that I included in our August monthly newsletter that was sent out yesterday. This chart shows the corporate insider buy-sell ratio. And for those that don't know, this ratio tracks the rate of buying and selling of people who have insider information on publicly traded companies. So for example, people in the C-suite, or members of the board of directors at companies. And insiders sell stock at any point in time for several different reasons. There's literally could be hundreds of different reasons for insiders to sell stocks, and that's not really telling with where the market is going in terms of calling a market top or a market bottom. However, there's only one reason why insiders buy stocks heavily, and that reason is to make money. And by looking at this chart, one could pretty much come to the conclusion that corporate insiders have a pretty decent track record when it comes to timing the market on calling a bottom. So when the blue line you see above crosses above the green horizontal line, it indicates heavy insider buying, and vice versa. When the blue line crosses below the red horizontal line, it indicates heavy insider selling. So right now, obviously, if you look at this chart, insiders pretty much bottom ticked the market in March of 2020 when they ramped up buying again, and they're doing the same thing right now. So again, I'm not saying that the bottom is in. I think that there's a lot of evidence that might suggest we've seen the worst of it. But when you see insiders and corporate executives, buying stock at this level, I don't think they would be doing it if they thought there was a longer drawn out potential for a really, really bad, harsher bear market. So again, I included this in the newsletter that was sent out yesterday. That's pretty much all I wanted to share with everybody today. So what I'm going to do is I'm going to stop sharing my screen, and I'm going to turn it back over to Matt here to be able to give his 2 cents on the market as well.
Thank you, Mark. Again, my name is Matt Jessup, CEO. I wanted to kind of provide my 2 cents, kind of build on what Mark said. I'll say I got 4 kind of main points to build upon what Mark said. First, I want to talk about the Federal Reserve. As most of you probably have seen in the news, the Federal Reserve just hiked interest rates by 0.75% just recently. I think this is setting them up to kind of front load all these interest rate hikes that as we go deeper in the year, they're going to do less and less. The next Fed meeting is scheduled for the 3rd week of September. My 2 cents is, they could do upwards of 1/4 point, maybe even 1/2, but most likely little. And I think it starts to send this message to the market that the Fed is slowing down on these interest rate hikes. That provides Wall Street a lot of predictability in the cycle. And I find that very, very bullish from that standpoint. Another factor, I know Mark talked about some of the statistics behind 2 consecutive quarters of negative GDP and how that tends to be actually optimistic because it tends to be priced into stocks. And Mark talked about those forward-looking returns. When you look at history where the market has a single quarter where the S&P sells off by more than 20%, and there is a data set of about 9 different instances going back to 1962, and according to Bespoke Investment Group, where we get this data, when you look at roughly the next 6 months on average, it's up over 20%, and 1 year later at these multiple data sets, it's up over 30. I'm not insinuating that it's guaranteed it's going to do those types of numbers, but when you look at history, it's telling us that this is relatively a good spot with the amount of correction that we've seen in the market. The next 2 points I'd like to make before we turn it over back to Jenna is earnings season. Every 3 months, publicly traded companies have to report their earnings to shareholders. We are in the midst of kind of the tail end of Q2 earnings season as we speak right now. What Mark and I are seeing is a lot of our names that we track very closely, they're actually financially performing very well in this economic environment. And I think it's kind of sending a message to investors that, hey, wait a minute, maybe a lot of these stocks got sold off way too far. And when companies are beating, you're seeing very positive reactions in their stocks. And I think that that is a big, big tell. The last point I like to make to build upon what Mark said is this point. In my opinion, I think the stock market is about 9 months ahead of what I would call Main Street America. And what I mean by that is it's very common for the market to bottom, and what people see on Main Street America will continue to get worse before it bottoms on Main Street America. The best analogy I like to use is back in 2009. And that chart that Mark showed at the very beginning with all those different reasons that people get very concerned about the market. One of the beginning ones, if you noticed in March of 2009, is it showed a single month of job losses at that time that was over 600,000 job losses. Do you want to know what that coincided with? It coincided with the fact that the stock market bottomed that exact month. And it didn't feel that things got better in Main Street America until about November of 2009. And I vividly remember that time period. I think it's going to be very similar. I think that things in Main Street America have the chance to get worse before they get better. But remember, the stock market does a good job in trying to price in the future. And I think it is very realistic that you see a rally going into the end of the year, even though things in Main Street America might not seem to be getting better just yet. And know there's that disconnect. And that's the big point that I wanted to make. That's all I have. I would like to turn it back over to Jenna, who could describe our next segment, which is the Q&A. Jenna?
Yes, thank you, Matt. Just a few pointers. The way that we're going to hold this Q&A, we're going to use the raise your hand function. So 2 different ways of doing it. If you are on a desktop computer, there is a button at the bottom that says reactions. You're going to click on the reactions button, and then you're going to click on the raise your hand function. And then we'll see it on our end. We'll see the little hand raise, and we will prompt you to unmute yourself. And then you can go ahead and ask your question. If you are on a cell phone, same thing. There's a reaction button at the bottom. You're going to click that and then click on your name. And then you'll be prompted to click raise your hand. And then on our end, we will prompt to unmute you. So as of now, I'll just open it up for Q&A. Don't be shy. If you have anything you'd like to ask, let us have it. All right, Dennis. I've prompted you to unmute.
All right, can I go ahead? Can you hear me?
Yes, go ahead.
Okay. Well, first, thank you guys for doing this. This is very enlightening and very helpful. My question is, I hope people find this interesting, is something called the volatility index, or it's called the VIX. About all I know is if the number goes up, that's not good. And if it goes down, it's better. But maybe just a short description of what items make up the VIX and why people pay a whole lot of attention to that number.
Yeah, it's a great question, Dennis. We actually get this a lot, and I'll start if that's okay, Matt, and you can add some stuff after it. But essentially, what the VIX is, Dennis, is it has to do with option trading, and it's essentially the short version of it is it's investors buying protection against a future market decline. And when the volatility index goes up, it signals that people are positioning themselves more defensive and give them the opportunity at some point in the future to sell a certain stock or an index like the S&P 500 to somebody else at a certain price. So when somebody essentially buys a put option, buys a put option on the S&P 500, they have a right to get rid of that at a future price and be able to make money off of that. So essentially has to do with option trading. The more the VIX goes up, the more people are buying protection against a market downfall in the next several months or several years. And it's just a kind of a way to hedge a long stock portfolio, if that makes sense. Is that decent, Matt?
Yeah,
I wanted to try to do it without getting too into the weeds on it.
Yeah, it definitely can get complex. I think Mark did a good job given the basis. The reason I like kind of watching the VIX from our kind of windshield, Dennis, is it definitely is one of those market tells to give us an idea how much the market's concerned to what the internal stresses are. And kind of the rule of thumb is anytime that index, and this is a general rule of thumb, anytime that index is below 20, you definitely have a risk on type of environment in the market. Anxiety is definitely lower. When you're in that 20 to 30 range, you definitely have elevated anxiety in the market. And anytime you're above 30, that tends to be a very volatile type of market environment with some of the backdrops and the underlying trends that Mark mentioned. I like to look at it as just one of our tells that kind of tell us, how much anxiety there is in the market, how much people are hedged. And it definitely at times when it's elevated could be a pretty accurate contrarian indicator, especially when it's above 30. So that would be kind of my 2 cents and how I find it useful for what we do for clients.
Yeah, and a lot of it, I think that like the big moves that you see in the VIX sometimes, Dennis, is really due to like algorithmic trading. So if the S&P 500 drops below the 50-day moving average or the 200-day moving average, a lot of times you'll see a big spike up in the VIX because people are out there buying protection on an automatic algorithm basis. And that's kind of why you see these large swings up and down in the VIX index.
Okay. Very good. Thank you.
Yep.
Thank you for the question, Dennis.
Yep.
Joan, I'm
another
coming
one.
for
Yep.
you. All right, you've been prompted to unmute.
I just want to thank, well, Joan, you can comment too if she wants, but thank you very much for your expertise and things that some I haven't even thought about, but it just seems like a unusual situation in the sense that coming out of the pandemic, there's big demand, and then with Putin and so forth, they created all this spike in worldwide energy, which drives up all kinds of costs, both personal as well as all the cost to ship goods and stuff. So it's a very unusual situation where, everything's spiking up. So to counteract that, they have to basically try to slow down the economy. So the question is, I guess, what do you do under these circumstances? And so people, I think, don't want to not buy. So people are buying, traveling, even if gasoline's up 40%, 60%. People are, even average people don't want to slow down. So I guess, how do you adapt? It seems like a lot of the tech stuff, the big tech, has been overly knocked down. But anyways, thank you. And it's all about how do we adapt to the changing environment. So thank you.
Yeah. And I'll start with that, Jim. Thanks for the comments and the question. I think it's just sticking to our strategy, which it's always been to try to own the best stocks within the best industries, within the best sectors. And, people still are afraid to buy companies that are have sold off, 50 to 80%. And I think the right time to buy is usually when it feels most uncomfortable to do so. And once you're like, okay, I'm ready to get back into the market, I think a lot of people usually miss a lot of that rebound. So I think in this type of environment, it pays to be a contrarian investor. And that's why we're focused on high quality companies that we want to own for the next decade. And we're going to be using this opportunity of this sell-off that we're in right now, I think, to load up on some of those high quality names that we think are going to perform really well during market stresses, during recessions, during good times and during bad times. So it's really about sticking to that strategy about, holding high quality disruptive names that over the long term are going to be able to weather the storm a lot better than others.
I'll build upon that, Mark. You did a great reply. There's always going to be reasons for a market correction. And obviously the last good correction we had was due to the initial response to the pandemic in March, in April, back in 2020. Before that, it was the fourth quarter of 18, was pretty dramatic correction as well. And there's always going to be different reasons for it. And I think that what we do a good job with as a money management firm is taking advantage of those sell-offs to enter trades that we want to hold for a very long time with that overwhelming thesis of high quality. And I think that That is what we focus on. There's always going to be temporary dislocations. You mentioned high commodity prices. Those are starting to really come in as things start to normalize. And I think we have to be on the aggressive side of taking advantage of getting into companies that we want to own for a long time that are high quality. And I think that we're doing a good job with that for clients right now. So thank you, Jim, for the question. Very much appreciate that.
Thank you. You look like a good Civil War general there, Matt.
Thank you, sir.
With the full goatee and whatever. But thank you. I appreciate the idea of the low unemployment and people can move around to jobs is not a normal recession. So
it's not, Jim, and the savings rates back down to kind of pre-COVID levels, the consumer spending, with the gas prices starting to come in again, I think that's providing a little bit of relief. I mean, remember, 2/3 of our economy is consumer spending led. And so, we try to, Mark does a good job taking advantage of those themes, underneath the names that we end up buying and holding.
Any other questions out there, Jenna?
I don't see any right now. All right, Georgia. You've been prompted to unmute. Go ahead when you're ready.
The question that just came in made me think about the uniqueness of this situation. And I know you've probably talked about it and I've forgot, so I apologize for that. But do you think that when you look at kind of looking more at fourth quarter, like whatever way the midterms go, when all the news stops with the Chicken Little crap and people start realizing that certain things, do you think that's going to help the confidence part of it that stabilizes the market, or do you think that's when we'll see the uptick?
Mark, you want to start?
Yeah, to be honest with you, and again, this is just my 2 cents, Georgia. And as always, I always have a disclaimer out there. Is my guess is just as good as anybody else's, but I don't really think it matters, to be honest. We've had midterm elections in the past that have been, a red wave. We've had a blue wave, and we've had a mix of both, where there's more gridlock in Congress. And throughout any of those 3 scenarios, Q4 tends to be pretty strong, and it tends to be especially strong in the second year of a presidential election cycle, and that's what we're in right now. So I'm more about looking at these things in terms of cycles and less about if it's Republican or Democrat. And once we hit just right after the midterms through the first half of 2023 is the strongest couple of months for the market in a presidential election cycle. So that's what I'm focused on. And I don't honestly think it matters if, the Republicans take away some seats or if the Democrats retain some. Just my 2 cents.
Yeah, I look at it more like just the constant barrage of messaging, and does that impact it? Whatever color it is, to me isn't the point, but more just the constant messaging of, because Jim made a good point of the economy is good, the unemployment is low, but wherever you're at, the messaging seems to be the same, right? It's always like Chicken Little. I remember that from the housing crisis. Like every day it was like the sky is falling, the sky is falling. Does that messaging impact what companies do with their stock market at all, or it just messages us emotionally, but it doesn't really have anything to do with the market, right?
Yeah, it's emotional. It's emotional. And I can't remember if you asked this question, Georgia, or if it was someone else on a previous Zoom webinar, but I told everyone just to turn the news off.
Yeah.
Because it does more emotional damage than it needs to, because a lot of the stuff really doesn't in my opinion, have an impact on the stocks that we hold or the way we're positioned in client accounts. Again, our time horizon is really long. So any media bites over the next 6 months to a year, we really don't pay attention to. I mean, if there was a fundamental change in a company that we held, then we would take a closer look at it to see if we needed to make a change and get rid of it. But you know, like Matt said, some of the companies that we hold actually reported really great quarterly earnings relative to the rest of the market so far this quarter. So that just shows you the strength of these companies' moat, and you know, competitors just can't come in super easily and take their business. And even during times of a quote unquote recession, if you want to call it a recession or not, it's economic stress right now, and people are still spending money, and these companies are still growing their top and bottom line. So, you know, those are the things that we're focused on. We're really not focused on the media stuff. And to answer your question directly, I don't think it's going to get any better after the midterms. I think it's going to continue on, unfortunately.
Well, it made me think about it when Walmart did their earnings and saying that the changes in what people were purchasing had changed, but people were still buying. They were just buying different things. Like we're still, like you said, the planes are packed, people are shopping, but yet it impacted their stock because they said what they're purchasing is different. So I thought that was kind of like, you know.
Yeah, absolutely. And especially for, you know, for airlines, you know, the biggest thing for them right now is Jet A fuel is ridiculously expensive. And they're, for the most part, they're passing it on to what I know, to consumers. But like Jim alluded to, we're coming out of this weird time where people couldn't go out and travel and spend. And, you know, people are like, hey, I don't care what the economic environment is like. I don't care how much savings I have in my bank account. I'm going to go crazy if I don't take a trip or go buy something nice for my spouse or my kids. So it's weird. And I'm not a person that is, we've never been in this environment before, but it is a really unique time right now.
It is, and you're right. I don't like it, but I still spent $1,000 on my ticket for the end of this month.
Right,
which
that's the
is
thing.
Way more than I'm used to.
Yeah, so if the demand's strong enough, people are going to spend regardless of what the price is, and it's going to get to a certain point where people won't do it. But again, I think right now it's all about inflation. I personally think inflation has peaked and it's going to roll over the next several months. We've already seen that in commodity prices and some other metrics that I talked about last month and in previous Zoom webinars and newsletters. Again, my opinion is as good as anybody else's, but I think, you know, by the end of the year, you're going to see inflation come down significantly.
Yeah, I appreciate it. Thank you guys for doing this again. It's great.
No problem.
Hey, Georgia.
Anybody else before we sign off for the night and let everybody get back to their Tuesday evening? All right. Oh,
I just had a quick question or a comment, if I
Yeah.
may. Thank you. Thank you both very much. I very much believe in and appreciate your focusing on good quality companies and so forth. And we have to rely on you. I mean, we can know a little bit about the company, but you delve into it and we rely on your feedback. So that's a big deal. It's not just what our friends tell us, you know. I've had friends tell me, I think most 80% maybe of these quote tips I get from friends turn out bad. So we rely on you to really delve into stuff that we're not going to get into. So thank you both. I believe in that philosophy very much.
Thank you, Jim. Appreciate it, sir. All right, Jenna, I think we can leave it there for the evening.
Sounds good. And just a reminder, this will be uploaded onto our YouTube page. So if you want to go back and watch it, have any other questions, email us at inquiries@jessupwealthmanagement.com and we'll get to you as soon as possible. But thank you guys all for joining. And we will send out another registration in September if volatility is still prominent. So everybody have a good night. Thank you again.
Thank you, everybody.
Take care, everyone.